Hi everyone. We're just waiting for people to join the webinar, and then I will get started. I can see that the number of attendees are rising fast, which is quite exciting. So let's give it a couple of minutes just to bring everybody to the room. In the meantime, today I am dialing from the UK, and our expert is dialing from Paris. And we are delighted to present this webinar in partnership with API Events. So I can see that the number of people is rising still. So let's give it a few more moments. So I think I can start the webinar now. So welcome everybody to our webinar, an introduction to real estate financial modeling. My name is Sonia Martin. I am the CEO at Bayfield Training, and I will be moderating today. So first and foremost, I would like to introduce Andrew Ravetanetti. He's one of our senior financial modeling trainers, and Andrew is a senior lecturer and teaches the Masters in Finance at the Glion Institute of Higher Education in Paris. So thank you very much, Andrew, for being here today.
Thanks for the invite.
Right. So before I hand this over to Andrew, I would like to let you know a bit more about Bayfield Training. So we are a real estate executive education company based in Cambridge in the UK. And we have been more than 20 years delivering financial modeling courses in Excel for the real estate sector worldwide. Our courses focus on investment and development cash flows for commercial assets, such as offices, shopping centers, hotels, and co-working spaces. So the webinar will give you an overview of the several real estate financial modeling concepts and why these real estate models can be more complex than modeling the income stream from other assets. Whilst Andrew introduces the concepts, he will also be mentioning the areas that we are covering on the 5-week online course that Bayfield and API are launching in October. So how this is going to run. So the presentation will last 25 minutes, and we will have 10 minutes of Q&A at the end. So you have any questions related to the subject, so do please send us through the Q&A icon. You can find this on the right-hand side of your screen. And yes, I think that's it from my end, and I will hand this over to Andrew now. So thank you very much for listening. Thank you.
Thanks, Sonia, for the introduction, and good morning, everyone. My name is André Ravetanetti, and I am Senior Financial Modeler Trainer at Bayfield. It is my pleasure to welcome you on this webinar. So today, I'm going to provide you with a preview of the 5-week online course about real estate financial modeling of investment properties and development. In the next 25 minutes or so, I'm going to talk about the goal of financial modeling, the general structure of real estate models, the most important financial functions to estimate, and the role of structuring. So with that, you will have a general overview of the main concepts, but we are going to focus on some concepts that are fundamental to real estate financial models, but a lot more theory and practice will be covered during the 5-week online course. So with that, let's give it a start with the nature of real estate financial modeling. So if you are analyzing the opportunity to purchase an already standing building, or maybe if you are searching for a land plot to develop residential units on it, real estate financial modeling is the exercise that will help you support the decision making. In a sense, you will take into account a range of assumptions about the state of the market and the state of the property, and perform a series of calculations which will lead to the statement, should I invest or should I not invest? That's why the heart of financial modeling stands at the intersections of the theory of corporate finance, the financial math of time value of money, and the powerful functionalities of Excel to piece it all together. A real estate financial model will produce performance metrics as output, and we will see some as examples, such as IRR, NPV, equity multiple, cash on cash return, which at the end will provide an answer to the question how much the investment is worth to a potential investor. I stress the particular word worth, and at this stage, it is important to stress to differentiate between value, price, and worth. And understand the difference is key to also perform good at financial modeling. So value is an estimation of the exchange price that relies on the interpretation of market information. Whereas the value is the perspective of the market, the worth and its appraisal is an estimation of something that is specific to an individual investor depending on its risk return profile. And to make an investment decision on, let's say, for example, in this slide, a multi-let office building, the investor will just have to compare the value to the worth. If the worth exceeds the value, the investor can decide to invest because it will generate a profit or an added value from the transaction. And what is the price? The price is just the sum of money that is exchanged during the transaction. So in an efficient market, you will see that the three concepts converge. So you will have market value, exchange price, and appraised worth all be equal. And that's the case for efficient market. But of course, the challenge and the joy of real estate modeling is that real estate markets are not efficient. So you have to work out the difference between all of them in order to make a great financial decision. So now that I have introduced the goal of real estate financial model, let's take a look at the general structure of the actual Excel file. So here is a chart that shows you an example on an income generating cash flow of how the file structure is generally laid out. So those components can be structured the following way. On the left-hand side of the document, you will find together the inputs and the outputs. The reason for putting them all together is that you want to see the impact of any changes to your input on your decision. So you will always monitor the output for seeing whether your decision to invest will change or it would stay the same. The modeling exercise is an iterative process. So that's the sign with the two arrows that shows that it always goes through all the different components. So the assumptions that you have at the beginning are not set in stone. They always evolve depending on your business plan, the expectations of your investor, the expectations for the property, and your asset management strategy. So you will always have to do those changes and see how those changes affect the calculations and the outputs. When it comes to the input, you will categorize the input into two categories: the global inputs that relate to the general project, the timing of the project, the situation of the market, and input that are specific to the property. And one specific input for income generating property would be the tenancy schedule. And in the tenancy schedule, you will find conditions about the rent, the service charges, provisions, and turnover predictions. On the right-hand side of the model, you will find the calculations that are performed period by period at a frequency that usually match the rental payments. Why should it match the rental payment, you say? It's because you try to stick as much as possible to the reality. The exercise of financial modeling is just trying to estimate what the cash flows are going to be in the future for a specific investment. So the calculations of the cash flows are also divided into two categories, the same way as inputs are. you will find the project cash flow at the top that summarize the rental cash flows, the OPEX and CAPEX in terms of cost, any investment activities, and that net out in the net cash flow. At the bottom, you will find the rental cash flows. The reason you find any property-specific assumptions and calculation at the bottom is because you want the ability in your Excel file to extend those calculations as more tenants you are. So the more tenants you have in your properties, the bigger your file will become. And by putting that at the end of your file, you will be able to extend and accommodate a wide ranges of tenants. So to summarize, the whole challenge of modeling is to set up that whole exercise in an Excel file and accommodate a wide range of assumptions and strategies that will reflect what you want to do with this property. So that's really what we're trying to do in this course. You will try to represent a forecast that is closest to the reality, but to do so, you will need to increase the number of calculations, number of cells you would use, and you will increase in general the complexity of the file. So the key of this training is to help you manage, empower you to reduce the complexity of this file by introducing advanced function in Excel. So let's dive into that complexity that I'm mentioning. In income generating cash flow model, the complexity comes from what we call the rent function. The rent function is just a calculation that is derived from a given tenancy schedule provided as input. If you are imagining a single tenant building secured on a long-term lease, you would have difficulty to imagine like complexity, having any difficulties to model that. Now, if you're imagining a multi-tenant building that has tenants across multiple asset classes, such as office, retail, residential, and so on, you will start to realize that the number of lease covenants will dramatically increase and make that so-called rent function particularly difficult to implement in Excel and to calculate. The challenge is to create a rent function that covers all the different situations that you have in your tenancy schedule and that follows in this chart what we call a step function. A step function is a function that is stable between specific dates that in the particular context of rent function, we will call events or rent events. So those dates that we call and we refer to as rent events could be uh, start of the lease, end of the lease, indexation, rent review, lease expiry, void period, and all those events can happen at any point of time during the course of the life of the property. So the behavior of a step function becomes particularly challenging in Excel. And the general way we address that challenge is to introduce the if function in Excel. And the basic structure of a rent function becomes if you have a specific event, you will have a change in the rent, or otherwise, you will stick to the previous rent. And that will enforce this behavior of rent function where it's either stable or it has a particular change at specific events. And the change will be depending on a specific math. The usual math would be the one provided in this slide, which is a compounding growth, where you would multiply by 1 plus a specific rate to the power of the number of period. And that's the case because you will have an underlying growth on rent in the market, which is depicted at the orange line, that is picked up at specific events by your step function. So in this slides, we try to capture the logic of the rent function. It shows you already in Excel that it can become a complicated function because you have multiple events. So that will introduce nested ifs. And during the course, we would see ways to use advanced function to deal with many events and many lease covenants, hopefully to cover multiple asset class and to cover multiple lease covenants. So we will do that during the course. Now let's take a look at the model structures in a sample file. So you will see here that the model that I described in a particular example in Excel. So you can find back the different components. You find on the top left, you can recognize the global inputs. That includes the project start date or the target rate of return expected by the investors, simply called target rate. On the bottom left, you will see developed the tenancy schedule with information about the leases for two tenants. You will find the passing rents, the ERV, the lease end, next data reviews. And then on the right-hand side, you will see the two categories of cash flow. The project cash flow at the top, where you see the rent, the OPEX, CAPEX, sales price, and the net cash flow, and the rental cash flow at the bottom that forecasted based on the assumption of the tenancy schedule. The goal is to be able to fill in the middle the performance metrics that are here free, the IR, internal rate of return, the net present value, and the worth. You will see here the calculation using some of the functions in Excel. You will use the IR function to calculate the IR, the NPV function to calculate the NPV, and to find back the worth, you will add the purchase price to the NPV. So those are really what we will achieve at some point during the course of the training. So you will set up all of this, you will feel comfortable using all the formulas and be able to use the performance metrics that you will find to make a decision based on IR, NPV, and worth. So far, I gave a lot of example on income generating building, but that's not all we will see during the course. We will also talk about development. So developments are different type of investments where the focus will not be on rent function because you will have to develop, but the focus will be on costs. The idea is really to find the key component on the forecast of cost, which is basically just the capex. So what we will focus on with real estate development is to understand the risk returns linked to purchasing a land, develop a specific property in this land, understanding what is better to develop based on different type of analysis, and then see how the rhythm of sale of this particular investment will impact the outcome, so the performance metrics. What you see here, which is key to implement in Excel, is the distribution of costs. Costs could be distributed in many different ways. And in this slide, you see here approximatively that the cumulative investment has the shape of an S curve. And building an S curve in Excel is one of the fundamental things that we will teach you to implement real estate development cash flow in Excel. So the S shape is particularly due to the timing of construction, where a lot of the hard costs are occurring in the middle of the construction period. At the beginning, you just have the land, then you start building pretty fast. That's where you have this surge of cost between the land purchase and the shell completion. And then it further slows down because you're just having the finish of the building and you just start to sell. Hence, you end up with this S curve that we will implement in Excel. Further to that, within the course, we will investigate different type of cost structure in more details, the basis of the cost, the risk linked to cost overrun, the risk of delay, because the duration of developments is shorter for development than it is for income generating cash flow. We will implement that cash flow on a different frequency of payments. So we use monthly cash flow compared to quarterly cash flow in income generating property, and we will see what's the impact on the calculation and the impact on the general setup of your model. So finally, so far I talked about income generating property, development property. The last thing we're going to see in this particular course is to talk about issues with structuring. So when you think about investments, you need to also take into consideration how a specific investor will invest in the property. So far, I assume that the investment will be direct. So it will be a direct investment. The investor wants to purchase a specific property. That's what we're going to look at. Now here, with bringing the issue of structuring, I'm looking at the possibility that the investment will be through an indirect investment. So the investor will invest in a particular investment vehicle that I'm calling fund, and this fund is going to invest later on into the property. So if we consider now indirect investment, meaning investing through an investment vehicle, it brings further issues in the calculation of the performance. So we'll have to think about how this performance will be split between the different shareholders of the investment. And if I use the structure of private equity fund, the general relationship is organized between two types of shareholder. You will have the limited partner, the LP, meaning the investor putting down the capital, and you have the general partner, the GP, who is the manager who designs the fund strategy. And because one provides the money and the other manages the operation of the fund and the underlying deal, there can be a great level of debate about how much each should receive in terms of remuneration and how the remuneration should be split between them. And that's where we would see issues arising with agency problem, remuneration structure, and how to incentivize the manager, so the general partner, without impacting the return of the investors, the limited partners. And that's where we would see modeling of waterfall, structures of waterfall, which is very important when it comes to that type of structure where in general you will have an investor on one side and a manager on the other side. So let's summarize what we've seen today. Today, I mentioned the key components of real estate financial models with a particular example on income generating cash flow and development cash flow. I also discussed the general structure of the model to give you an example also in Excel, what it looks like, which is really the goal and what you will be able to do from scratch and error-free on Excel. Then we focused on particular area of complexity within the model that we will help you solve, which is the rent function, specific at the center of income generating cash flow, and the cost function, the distribution of the capex, which is at the heart of development cash flow. Finally, I covered private equity structured and remuneration structured to showcase more advanced structuring challenges that we are going to cover in Excel model. Those components provide you with an overview of the upcoming 5-week modeling online course, and that's what I wanted to cover today. So I would like now to give the lead back to Sonia for Q&A and closing.
Thank you very much. Andre, can you just move to the last slide, please, as well, so we can all see it? Great. Yeah, thank you very much for this great overview of the course. We are now moving on to the Q&A session. So do please use the Q&A icon if you would like to ask any questions related to the content or the concepts we have covered. In the meantime, we have had some questions related to the course. So just let me go through the slide. And so over these 5 weeks, you will learn the best practice of how to invest in income generating building, as well as development schemes. So the first 2 modules that you can see on the screen, we will be looking at creating an investment cash flow from scratch, making it more complex throughout the 2 days of the course, of the module, sorry. And the cash flow will cover the setup of rent functions for a multi-let property, including multiple leases features such as reviews, indexation, void, and tenant incentives. Okay, so the following module 3 and module 4 will be looking at reviewing the structuring of development cash flow from residual appraisals to the distribution of costs through the S-curve. And the last module, module 5, is a mix of investment and development. And you will learn how to model different strategies of real estate financing, whether in the context of investment or development properties. So that is in a nutshell what we are covering on each of the modules. So what else? Andre is the training of this course. He will be teaching the 5 modules. This course is hand-on Excel and it's virtual. We're using Zoom for the purpose. And we have limited places available. We also have guest speakers who will let us know their experience in the real estate sector. The course is CPD accredited as well. And in terms of how to attend the course, I will advise to attend all the modules to get the best learning experience. However, if for some reason you cannot attend them all, you can attend them separately. So if you're going to do this, I will advise to do module 1 and module 2 together, module 3 and module 4 together. And then if you have a really good financial modeling skills, you can either attend module 5 on its own, or you can attend module 1, module 2, and module 5, if that makes sense. And I think if you enjoy this webinar, the course will be very, very relevant to you. And I will have some questions related to the course content. We will be sending the webinar slides later today. And we will also attach the course outline so you can see the content for each module in more detail. And the course is from 10 a.m. to 4:30 p.m. It's the whole day. We have 1 hour for lunch, and it's a virtual, it's interactive. So, you know, if you have questions, you can ask the trainer. And yeah, that will happen every module. It will be that way. And some of the modules will have these guest speakers attending. And you would like more information about this course, you can also contact Gideon for pricing and for registration links, and also Jacob Noble, my colleague. He will be very happy to help. And yeah, I think that's it from us. Thank you very much, Andre, for giving us this brilliant presentation. Thank you to all of you for being here today. I can't see any questions related to the content, so I think that's it. And yeah, have a great day and stay safe. Thank you very much for attending. Cheers.
Thank you, everyone. Bye.
Thank you.